Hello everyone, my name is Cydney Nash and I'm a wealth manager, a certified financial planner, and a certified investment management analyst at Raymond Gurrell Wealth Management. Today, we'll be covering one of the largest and most important pieces of your compensation as an NVIDIA employee, your restricted stock units, or RSUs. In this video, we'll explain what RSUs are, how NVIDIA's vesting schedule works, the tax treatment of your shares as they vest, the decisions you'll face once shares are in your hands, and more. If you or someone you know could benefit from this strategy or other services our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine the opportunities for tax optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Let's start with the basics of equity compensation. Companies reward employees with equity in a few different forms, the most common being stock options and restricted stock units. Stock options give an employee the right to purchase company shares at a set price in the future, which means the employee must buy the shares to realize the benefit. Restricted stock units work differently. An RSU is a form of compensation that becomes available to you or vests over time. The shares are granted on a restricted basis, and you will receive them once the vesting conditions are met. Unlike stock options, RSUs do not require you to buy anything. Once they vest, the shares are simply delivered to you. NVIDIA, like many large technology companies, uses RSUs as the primary form of equity compensation. Before we go further, there are a few important terms to become familiar with. The grant date is the date on which the company issues the equity compensation to the employee. The vest date is the date on which the employee actually receives the shares. The vesting schedule is the timeline by which an employee earns and receives their equity compensation. And finally, cost basis is the original value of the shares for tax purposes. For RSUs, your cost basis is determined by the value of NVIDIA stock on the vest date. One quick note on terminology. Internally, NVIDIA often refers to its restricted stock units as NSUs, or NVIDIA stock units. The name is different, but they function the same way as RSUs. Now let's look at how vesting actually works for NVIDIA employees. Most NVIDIA grants vest over a 4-year period, and the shares are released quarterly. These shares are standardized regardless of when you start. They typically fall on the 3rd Wednesday of March, June, and September, and the 2nd Wednesday of December. Historically, NVIDIA used an even schedule where 25% of the grant vested each year, often after a 1-year cliff. More recently, NVIDIA has moved many new grants to a front-loaded schedule. Under this structure, 40% of the grant vests in the first year, 30% in the second year, 20% in the third year, and the 10% in the fourth year. In other words, you receive a larger portion of your shares earlier in the vesting period, while the shares within each year continued to vest on the same quarterly cadence. It's also important to understand that NVIDIA issues additional grants over time. Beyond your initial new hire grant, you may receive annual refresh grants, which are based on annual performance and typically begin in your 2nd year of employment. Because these grants overlap, The amount of stock vesting in any given year can grow meaningfully as your tenure increases. Let's walk through an example to see how this plays out. Meet Michael, an NVIDIA employee who receives a new hire grant worth $400,000, vesting over 4 years on the front-loaded schedule with 40% in year 1, 30% in year 2, 20% in year 3, and 10% in year 4. In his first year, 40% of the grant vests, which is $160,000. Spread across the 4 quarterly vesting dates, that is roughly $40,000 per quarter. In the second year, 30% vest or $120,000. In the third year, 20% vest or $80,000. And finally, in his fourth year, the final 10% vest or $40,000. Notice how this front-loaded structure delivers a significant amount of income early, then tapers off in the later years. This is the key point. Because so much of the grant vests up front, Michael could see a large spike in taxable income during his first couple of years, especially once annual refresh grants begin stacking on top of his original grant in year 2. For high earners at NVIDIA, this can push a substantial amount of income into your top tax bracket, which makes planning around these vesting events especially important. So let's talk about how RSUs are taxed. The first tax event occurs at the vest date. The IRS requires NVIDIA to include their fair market value of your vested shares in your income for that year. This amount is taxed as ordinary income, and it also becomes your cost basis in the shares going forward. When your shares vest, you generally have 2 options for handling the taxes. The first is to sell just enough shares to cover the required withholding and keep the remaining shares. The second is to sell all vested shares and receive the proceeds. One item worth highlighting is that NVIDIA's default withholding may not be enough to cover your full tax liability. The company generally withholds at a federal rate of 22% or 37% on amounts over $1 million, but if your compensation places you in a higher tax bracket, that withholding can fall short. For example, if you earn a base salary of $200,000 and another $300,000 of RSUs vest in the same year, your taxable income can climb up to $500,000 and push you into a higher tax bracket. If only 22% was withheld, you could owe a meaningful amount when you file. This is a common reason NVIDIA employees face an unexpected tax bill, and it's something our team helps clients plan for proactively. After your shares vest, any future movement in the stock price creates a second potential tax event when you eventually sell. If you hold your shares for at least 1 year after the vest date, any additional gain receives preferential long-term capital gains treatment rather than being taxed as ordinary income. Let's put numbers to it. Say, one of Michael's vested installments is worth $40,000 and it later grows to $52,000. If he sells within a year of vesting, that $12,000 worth of gain is taxed as ordinary income. In a 32% tax bracket, that's $3,840 in tax. If instead he holds for more than a year and qualifies for a long-term capital gains tax treatment, that same $12,000 gain might be taxed at 15% or $1,800. Simply being intentional about the holding period saved him roughly $2,000 on a single installment. Once your shares have vested, you generally have three paths forward. First, you can sell immediately and use the proceeds to cover current or upcoming expenses. Second, you can keep the shares and do nothing. Third, you can sell immediately and reinvest the proceeds into a more diversified portfolio. This decision matters more than most people realize because holding a large amount of NVIDIA stock introduces single stock concentration risk. NVIDIA stock has appreciated dramatically over the past several years, which has been rewarding for employees, but it also means a growing share of your net worth may be tied to a single company. If too much of your wealth is concentrated in one stock, a decline in that single position can have an outsized impact on your overall financial picture. It is also worth remembering that any invested shares are generally forfeited if you leave the company, so the timing of a transition also matters. For employees who want to reduce that concentration without triggering a large tax bill all at once, there are advanced, complex strategies worth exploring. One example is direct indexing, which enables personalized tax management through ongoing tax loss harvesting across hundreds of securities. Those harvested losses can be used to offset the capital gains generated when trimming a concentrated NVIDIA position, then potentially reducing or even neutralizing the tax impact of diversifying. As always, the right approach depends on your specific situation, your other income, and your other long-term goals. Especially since employees may have a mix of different vesting schedules, we recommend reviewing these decisions with a qualified financial and tax professional, such as the team here at our firm. Thank you for joining us today to learn about NVIDIA stock compensation and how to make the most of your restricted stock units. At Raymond Gorel Wealth Management, we have over $1 billion in assets under management. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.